Welcome to this explainer. We're diving straight into a quantitative market intelligence report to objectively analyze what's happening in the market right now. We're taking a purely data-driven approach today, looking exactly at what the algorithmic scanners and technical sheets are spitting out. Just a quick note before we get deep into the weeds. This is a market technical analysis overview. It is not investment or trading advice. It's just technical analysis, so always do your own research.
Right, so let's get our disclaimers out of the way so we're all on the exact same page. First off, this deck is strictly based on technical analysis, historical chart patterns, and market indicators for educational and analytical purposes only. Second, there's absolutely no advisory or buy-sell recommendation here. Nothing we talk about constitutes financial advice, investment guidance, or a push to buy, sell, or hold any security. And finally, a really important market risk warning. Trading and investing in financial markets carry inherent risks. Key levels and patterns can and do fail because of sudden market volatility. So please evaluate your risk tolerance and talk to a certified financial advisor before making any financial moves. All right, let's get to the good stuff. Here's our roadmap for today's explainer. We'll start with index trend and volatility, move into sector strength and weakness, check out the algorithmic signal landscape, and wrap up with a deep dive into specific technical patterns. All right, let's kick things off with Section 1, Index Trend and Volatility. We're going to look at broad market conditions and overall structural health. Okay, so looking at this visual, we've got both the NSEI and NSE Bank, and right now they're hovering in what is very clearly a neutral momentum phase. If you glance at the left side, you'll see the 5-day trend depth shows the NSEI is down about 1.46%, and the NSE Bank is down 1.12%. We've also got a MACD indicator that's pointing downward. But, and this is a big but, if you look over on the right, the gauges highlight something absolutely critical. Both of these indices are approaching their structural support proximity zones. So yeah, they're bleeding momentum, but they're basically landing right on top of crucial structural floors. Now let's drill directly into the raw data from the sheet, because this shows exactly how tight things have gotten. The NCSEI closed at 24078.3, and just look at its support level right there at 24025.65. That is an incredibly tight buffer. It's practically sandwiched right between its immediate support and a resistance band up at 24172. Plus, we're seeing a pretty neutral to bearish RSI of 40.2. And honestly, the NC Bank is telling a super similar story. It closed at 57239.75, with support practically knocking on the door at 57001.75, carrying a completely neutral RSI of 51.3. Basically, both major indices are walking a serious tightrope right now. Let's pivot to Section 2, Sector Strength and Weakness. We're going to track some institutional money rotation here. So beneath the surface of those neutral indices we just talked about, there's a pretty stark divergence happening. Most sectors are clustering around that neutral 50-level momentum line in the middle. But check out CNX Realty. It stands out dramatically. It's flagged as the single bullish trend on here, sporting a high relative strength index of 72.0 and a really solid volume ratio. Then, on the complete opposite end of the spectrum, way down in the bottom left, you've got CNX IT. It's flashing some serious weakness. Its RSI is dragging down into the 30 to 40 zone, accompanied by some deeply negative MACD momentum. To really put those numbers into perspective, we've got to compare their recent performance directly against the broader market. Looking at these 5-day percentage changes, the quantitative weakness in CNX IT is just glaring. It dropped 2.87%, meaning it's lagging way behind the broader NSEI index, which only dropped 1.46%. But you know what's really fascinating? Even our bullish outlier from the last slide, CNX Realty, took a 5-day drawdown of 2.12%. What does that tell us? Well, it essentially means that even the sectors with the absolute highest underlying momentum and RSI strength simply couldn't completely dodge the broader market's gravitational pull this past week. Moving right along to Section 3, the algorithmic signal landscape, where we'll look at high-conviction setups and signal distribution. Okay, taking a look at this signal landscape, you can see the market is severely lopsided right now. Systemic, exponential moving average conditions, and specifically, we're talking about where the 12-day EMA crosses below the 26-day, which then crosses below the 50-day, have triggered a massive algorithmic tilt toward short breakdowns. I mean, just look at the top of the funnel here. It's practically a sea of red. Right below that, the scanner is aggressively firing off mean reversion signals, basically hunting for bottoms in oversold conditions. And at the very bottom, there is a serious, severe scarcity of your standard long breakout setups. The momentum is just heavily skewed right now. But here's where it gets really interesting. Within that heavily bearish tilt,
The high conviction matrix reveals this fascinating dichotomy in how the AI stock scanner is actually categorizing its absolute best signals. It isn't just blindly selling off everything in sight. There is actually a very specific, calculated logic to what it's scoring highly. The data shows us that the scanner is strictly targeting two extreme ends of the spectrum. For its highest scoring buys, these are these score 9 setups like Crompton and NBCC, it's exclusively looking at deeply oversold mean reversion plays. These stocks have been absolutely crushed, registering RSI levels of 34 and 28 respectively. Now flip to the other side. For its highest conviction sells, like Fortis and Somacap, the scanner is aggressively flagging high-volume momentum breakdowns. Somacap, for instance, is breaking down with a massive volume ratio of 2.56 times its normal average. So the algorithms are essentially doing one of two things. They're either shorting the weakness on incredibly high volume, or they're trying to catch a falling knife that's just stretched way too far.
Let's bring it all home with Section 4, Deep Dive into Technical Patterns. We're going to zoom right into Bollinger Band behavior. The Bollinger Band retest is a core quantitative pattern in this report. Essentially, it measures whether a stock statistically bounces off or outright rejects the midband after an initial price movement. On the left side, panel A illustrates the bull retest bounce. That's where the price comes down to the midband, finds solid support, and pivots back up. Pretty straightforward, right? Then on the right, in panel B, we have the bear retest rejection. This is where the price rallies up to the midband, completely fails to break through, and gets violently pushed back down. Let's look at the actual stocks triggering these exact patterns right now.
Staring directly at the bull retest bounce data, we're seeing some really high-strength signals pop up in the heavyweights. Reliance, which closed at 1316.0, successfully held its Bollinger Band midline, accompanied by a really healthy volume ratio of 1.19. And we're seeing similar structurally sound bounces in Tata Steel and NMDC too. Both of these feature volume ratios well above 1, which is a great sign. It tells us that buyers are actually stepping in at these technical support levels to actively defend the trend.
On the flip side, the bear retest rejection table paints the exact opposite picture for several key names. Stocks like AD&EN rallied up toward their midband but aggressively rejected it, closing down at 2995.5. Now, what's crucial to note here are the RSI levels accompanying these rejections. AD&EN is sitting at a very weak 31.7 RSI. Apollo Hosp and Amber are also failing right at resistance, generating maximum strength level 5 bearish signals in the system. Make no mistake, the algorithms are clearly flagging these as structural failures. So, given these strictly data-driven parameters, we are left with an absolutely fascinating setup. The major indices are literally balancing on a knife's edge of structural support. The algorithmic scanners are heavily tilted toward volume-heavy shorts, yet at the exact same time, they are isolating deeply oversold mean reversion bounces for their highest conviction buys. It's wild. So you really have to ask yourself, how long can this divergence hold? Are we going to see a broader market capitulation that finally breaks those index support levels once and for all? Or will a violent mean reversion recovery take over and totally punish that heavy short positioning? The data lays out the battleground perfectly. It's up to you to apply this analysis and see how the market reacts. Thank you so much for joining me for this explainer, and keep your eyes on the data.